Ladies and gentlemen, thank you for joining us today. My name is Vaughn Newman, and I am a home financing specialist at the Cable Beach branch. We are pleased to be able to share an economic overview of the Bahamas with you this afternoon. Our presenter, Deno Moss, will take you through a presentation, and at the end, we invite you to ask questions. Before I hand over to Deno, allow me to share a little bit on Deno Moss. Deno is a global wealth advisor, portfolio manager, and director, wealth management with Scotia. He has had 20 years of experience in the financial industry in Canada and across the Caribbean, which has provided him with a unique perspective on the needs of his global investors and the nuances of the international investment markets. In his past roles, he has managed advisory and discretionary portfolios for some of the largest pension funds and high net worth clients in the Bahamas. The insight he has gained through his development has benefited his clients with the ability to meet their complex and changing needs. Deno is a graduate of the University of Western Ontario with a Bachelor of Arts degree in economics with finance. He holds the Chartered Investment Manager designation, CIM. In his free time, Deno serves as a chartered member of the Rotary Club of Nassau Sunrise and a founding member of the Friends of the Nazareth Center. I now hand over to Deno for the presentation.
Thank you very much, Vaughn, for that warm, welcoming remarks. Good evening, everybody. And I thank you very much for taking the time out of your busy schedule to join us this evening for what I hope would be an enlightening presentation. What I hope to do today is to go over some highlights of what Scotia Wealth Management's outlook is for both the global economy, and I would hope to piggyback and bring to for how that can resonate for decisions that you can make with your investment portfolios here. So we'll talk about our expectations for growth globally. We'll talk about fiscal and monetary policy and the stimulus to those. We'll cover central bank policies. We'll talk about financial conditions and inflation effects and where we are with our policy construction. And we'll also talk about sovereign bond debt, monetary policy, and the tapering of risk. The numbers so far this year have shown that the policymakers continue to be very accommodative in helping the global economy combat the COVID-19 pandemic. The risk assets in this space have performed very, very well. And this has been helped by corporate profits and also the low levels of risk. So the global economy has been supported by the accommodative policy measures, the easing of lockdown restrictions and people getting back to work, and the rising vaccination rates have also made people feel safer and more willing to continue the activities of their daily life. And this has reflected or shown forth in consumer spending and also in corporate expectations for continued growth. And this has flowed over to asset class performances. Mostly equities and commodities have seen the bulk of the growth here. And the earnings per share growth you'll see in the US and Canada remain positive, and the multiple expansion has continued to grow here. Commodity assets, gold has increased by 3.4% in the first half and continues to gradually increase. We see inflationary pressures coming in some of the inputs, including natural gas and crude oil. And so when we look at these things and look at portfolio construction, what we look at is we try to figure out how to manage risk and volatility. We can't erase them completely, but we feel that diversification is the key. And the graph on my right here, the table on my right shows year by year from 2019 to 2021, and also 15-year annualized, how different asset classes have performed over those periods. And we can see that no single asset class outperforms every single year. And so diversification is key when designing a portfolio. Our return expectations are a little bit lower than historical averages. You'll see here that in the US, we're expecting equity market returns over the next 10 years to be around about 6.3%, where historically that's been about 16%. Internationally, we expect returns to be 6.6%, and we expect fixed income returns to remain very low. What we do is we take these return expectations and we overlay them with a tactical asset allocation to help to not only diversify the portfolio, but to look for opportunities to enhance returns depending on where geographically and also in asset classes where we believe that there is room for outperformance. The global economy continues to improve, and this is seems to be all across the board, where you're seeing improving corporate profits and pent-up consumer demands are leading to more and more consumer spending. Things that we have to watch out for, though, is we see commodity prices have been climbing over the recent periods, and labor market has been constrained. And so the commodity price increase, as well as higher wage rates, could prove to be disruptive by squeezing corporate margins and also causing asset prices to continue to climb. One of the things that will continue to be a factor in the economy improving over the period is the acceleration of vaccine distributions. Here we see distribution of vaccines in the developed world far, far outpacing the undeveloped world. And we can see this very same scenario play out here in the Bahamas as well, where countries like the US, Canada, and the United Kingdom are far more vaccinated as a percentage of overall population than we are in the Bahamas. And what it does is the more vaccinated a population is, the more comfortable people are to going out and to continuing the activities of their daily life. This is very important for us as a country, because we depend heavily on tourism, and the more comfortable tourists feel coming into the Bahamas, the lower our infection rates, the higher our vaccination rates, the better it will be for us and our economy. Things to consider going forward, though, are we can see growth start to normalize. We've had high growth coming out of the pandemic, but we can start to see that moderate a bit, and the risk factors associated with that could be the impact of other variants in the pandemic. We see the Delta variant and what that is doing, and the havoc it's wreaking on unvaccinated persons. The policy accommodation may start to diminish as growth improves, and so we have to be cognizant of how that could negatively affect financial assets as conditions improve and the policymakers rein in some of their spending. The stimulus incentives and supply-demand imbalances have led to spike in inflation, and this has put pressure on costs and wages. And as it leads to inflationary pressure, we can see effects on financial assets here as well. But so far, asset prices have reflected improving fundamentals. The investor sentiments remains strong and up at very high levels, though in the last 2 or 3 months, we've seen a little more volatility creep into the markets as investors are becoming more and more cautious going into the fall and the policy decisions that could be coming out of the fall. Globally, though, what this graph and this chart here is showing is that we expect strong growth from most economies globally, and it continues to be strong going forward. The labor shortages and some supply demand imbalances will continue to put some pressure on the global output, and we've seen that in things from things like the chip supply, and that has affected everything from computers and laptops to automobiles and other smart devices. The inflationary prices that we talk about, if we look here on the left, up to the first half of 2021, inflation seemed to be running at a breakneck pace. But if you look on the right-hand side, you'll see that this is starting to taper off, and we're starting to see prices start to come back down. And so we believe that the inflationary pressures will taper off and become more normal as we move more and more into a recovering economy. It's interesting to see where some of the increases in prices have been. For example, used car sales. As I mentioned earlier, there was a shortage in chip supplies, and that affected deliveries of new car sales. And so used car prices at the very early stage of the pandemic in September 2020 contributed significantly to increasing prices, and it seemed to have come back again in the ending part of the second part of 2021. But those things are starting to taper. We expect growth to continue, and we expect that the policy support to that growth will continue as well. And so if there've been policy support in all of the major central banks around the world, and it has helped the markets to continue to remain strong here in the US and in Canada. Okay, but the impulse is now expected to wane. We expect that the transfer payments to individuals to start to taper off. Governments will start to shift their focus away from fighting the crisis and directing new spending to improving long-term growth potential. So in the US, we are looking for and getting closer to seeing the infrastructure package signed, and that will improve the transportation and broadband and power distribution throughout the US. And in Canada, we are seeing extra spending, focus on grain development and technology. And we're seeing the same type of sustainable spending into the European Union as well. We believe that there is room here for capital expenditure, mostly on the part of businesses, to continue to put the cash reserves to work and be able to turn that into profitable earnings for the companies. We, on the consumer side, pent-up demand is causing us to see consumers come out and move to spending as well. And a lot of it is moving to the recovery sectors. And so we're looking at things like recreation, accommodation, air travel, and even in the Bahamas, if you look at, compare the first half of 2021 in air arrivals to the Bahamas compared to the first half of 2020, we've seen a huge pickup in that, and that has come from these developed economies that are seeing improving conditions. On the microeconomic space, we can see that GDP growth over this period from 2019 to 2021, and this is the expectation for the end of the period, we're seeing GDP growth we're expecting a great pickup in 2021, coming off the back of 2020, where it was actually negative in Canada. Unemployment rates are starting to taper as well. And we're seeing expecting interest rates to continue to move a little bit higher. And so we'll continue to watch that, because as interest rates on fixed interest instruments improve, there's potential to see assets flow out of equities and some of them into fixed income. And so we will continue to monitor that. But all in all, in Canada, the post-recovery continues to be very optimistic, and we're looking forward for continued growth. Housing market in Canada boomed into the pandemic, with lots of people chasing few houses on the market, looking for more space for their families, and looking for, and even some speculation. House prices increased dramatically, and the amount of inventory, as you can see here, new inventory coming on the market increased as well. The new inventory coming on the market now, though, is not as pronounced as it was in the early days of the pandemic. And so we are looking to see, and house prices are starting to come back down again. That may be contributing to why not as many persons are listing their houses. But we believe that run-up in house prices may have been a bit overdone. And the commodity prices here, we see the same thing. The commodity prices ran up in 2020 and into 2021, but we're starting to see, as I mentioned earlier, we're starting to see those retrace a bit, and we continue to monitor those to see where we go from there. In the US, we see very much the same picture here. The GDP growth from 2020 to 2021, there's a great reversal on the positive side. Inflation, we're seeing inflation creep up a bit, but that's expected with the price of all of the inputs, from raw materials to labor costs, but we hope to see that tapering. Unemployment, we're seeing unemployment trend down as more people go to work or leave the labor force completely to focus on family and other things. Here again, interest rates, both in the 10-year and in the 3-month, we're seeing interest rates start to creep up. And so there's some cautionary things to watch for here. You'll notice that the federal debt to GDP here in the US has climbed from 78%, 78% to GDP up to 105 in the pandemic with the spending. In the US, this graph shows that as job openings increase, so do wage and salary disbursements. And as I mentioned earlier, the wages seem to be continuing to put pressure on pricing because it's harder and harder to find individuals willing to work. And so companies are providing extra incentives, increased wages, other benefits to individuals to try and encourage more and more people to come into the labor market. In Europe, the picture is not all that different. The GDP growth is reversing. Inflation is climbing, but unemployment in Europe is still basically stagnant. The fixed income rates are climbing, but not as aggressively as we saw in the US and in Canada. The GDP, federal debt to a percentage of GDP in Europe is actually going in the opposite direction, coming from almost 85%, going down to about 81% projected for 2021. As we look at the Bahamas space, we can see inflation, according to central bank numbers, are remaining muted. Unemployment in the Bahamas is continuing to increase or remains high, while interest rates are relatively the same, but our debt to GDP has increased and it is projected to be in well into the 80 to almost 90% of GDP by the end of fiscal 2021. The rest of the world, we can see that inflation is higher than the developed world here, and unemployment kind of remained the same. The fixed income interest rates continue to inch marginally higher, and the federal debts to GDP remain almost flat as well, just climbing from 51.2% up to 57.6%. The central banks, leading central banks around the world, continue to be accommodative with their monetary policy and to help to taper the effects of what COVID-19 was doing. But they're all talking about reining that in a bit and watching and focusing more on long-term fundamentals. How does this play into our equity weightings and what we decide to do with our portfolios? Here, what you can see from this is that for equities, we continue to remain neutral weight. We're not overweight as equities in total or underweight. In Canada, we're neutral. The US, we're very positive on equities in the US. And so we continue to focus heavily on the US equities, but internationally, we are scaling back a bit and have moved to an underweight position there. Okay, and this shows our preference for developed markets versus emerging markets, where we believe that near-term risk suggests an intra-year correction may occur, which could create attractive entry points. So here we're continuing to keep some cash ready to use as dry powder for if a correction were to occur, we can take advantage of that opportunity. And we remain underweight international equities, as I mentioned. But investors are looking beyond 2020, 2021 for earnings expectations. And here you can see that the valuations are improving. The high PE ratios are coming down in the US, internationally, and in Canada, suggesting that assets may be coming back into levels that are not as highly inflated. And earnings growth is expected to surge in 2021, followed by modest gains in 2022. And so we believe that we will not see the type of equity market returns that we've seen in 2019, 2020, and even the first half of 2021, but we still believe that equities will generate positive returns. Okay. And we believe here that US equities offer are higher versus their peers. And this is due to basically the quality of the US equities, and also the level of the level of oversight, the level of regulation, and the development of those markets. And so we expect these to continue to perform well. Debt, US companies on average have a lower debt than their peers internationally. And so we expect the returns on those companies, returns based on invested capital, to continue to be higher, and attractive risk-adjusted valuations are in the future. The earnings per share contribution by sector in different markets can be seen by these various circle graphs. In fact, in the US, you can see that information technology, financials, and health share make up the largest component of the earnings per share contributions in the US. In Canada, a much larger contribution comes from the financial service sector, and materials is a second in Canada, but a distant second. The equity risk premium is basically, we believe that corporate profits, the consensus estimates are used to calculate market short-term earnings growth rate and payout ratio, total payout to shareholders, including both dividends and share buybacks, is reflected in this graph as well. And the long-term growth rate in GDP and corporate profit earnings growth have typically converged over time, and the discount rate, or the expected inflation over a 5-year period, begins 5 years from today. And so looking at this graph, we're seeing that our equity we believe that the risk associated with equity is going to reward the investors who take the risk and venture into equity over fixed income investments. Okay. From a historical perspective, we believe that equity earnings per share determine how expensive or how cheap a company may seem. And so here at about 7%, you see that the US equities are kind of right here, just a little bit over to the cheap side versus expensive. In Canada seems to be sitting right on, almost right on the line. The earnings per share valuations, though, we need to pay attention to what those are, but also we need to pay attention to interest rates historically. So where earnings per share numbers may have been lower than what we're seeing today, the interest rates historically have been much higher than what we're seeing today. And we can use all of these things to help to determine where we position and how we position assets over time. And so in our 10-year growth rate, based on the average 1-year return, we're expecting a kind of on a 10-year implied growth rate in a neutral position can look at like about 9.7%. And the 2.1% here at this level. What is fixed income looking like, and how are we positioned with fixed income? You can see across the board here, we are underweight fixed income, with the exception of global investment grade debt, where we have a neutral bias. But fixed income, we're not going to get, even though we expect returns on fixed income to remain muted over the long term, we're not going to move completely out of fixed income because they remain an important part of a diversified portfolio. They can help to normalize the portfolio when we see unexpected shocks to the negative side in the portfolio. And they also, we know that nominal government bonds are a poor hedge against inflation, but as I said, they offer portfolio stability in elevated volatility periods. In constructing a fixed income portfolio, though, it's very important to be very cautious in how you do that. We expect long-term rates to continue to move higher. And so it would be prudent to construct a laddered portfolio where we can move to more, whereas bonds on the short end mature, we can move out to the longer end of the curve and take advantage of the increasing interest rates there and add lift to the portfolio. As we've seen, the financial markets, the financial conditions remain accommodative to the markets, and we believe that the Fed Reserve and other central banks will be very cautious and monitor markets and the general growth of the economy if and when they begin their tapering process. As interest rates increase, we expect to see more money move into bonds, and we expect to see a bit of a sell-off in equities at some point. And as I mentioned earlier, we would view that as buying opportunities. The foreign investors continue to provide cash to US markets to continue to help those markets stay buoyant. And we believe that that is going to continue into the future. Okay. Expectation. So this just shows what I mentioned about us expecting interest rates to continue to increase. So the current rate is illustrated here in the red line, and going forward, we expect 1 year, 2 year rates to continue to increase. You'll see it greater in the short to medium term of the curve, and the longer term rates, we expect those to stay pretty much converged. It appears that we are in what we call a late cycle valuation. And so what you're seeing here is that in high yield credit, normally the spread between high yield credit and treasury is 562 basis points. Currently, that spread is only 160 basis points. And so we believe that buying high yield bonds at this point could be a very risky venture without the corresponding benefits or expectation of profitability here. So we're staying into investment grade rather than high yield. So in summary, we have volatility will likely remain elevated as risk persists and market expectation reflect optimism, and inflation uncertainty is rising. Long-term growth, inflation, and interest rates remain anchored by long-term secular trends. We strongly encourage diversification in all portfolio construction, and we encourage you to use prudent risk management strategies, and that includes asset class diversification, but also geographic diversification, so that you're not concentrated in one economy, so that if there's a shock to the one economy, you have alternative assets working for you. The total return or alternative investment strategies may also play an important role in a well-diversified portfolio. And so this is my presentation today. Thank you very much, and I open the floor for questions.
Thank you, Deno, for your questions. For the presentation was very insightful. One of the questions I'd like to ask though, as you speak about diversifying the portfolio, the stock prices are very, very high. What is your take on it? I mean, do you see this correcting at any time, and do you think it's a good time to be investing in the stock market?
That's a very, very good question. I get that all the time. And from my very, very early days in this profession, one of my greatest, people I follow was Sir John Templeton, who said that the best time to start investing was 20 years ago. The next best time is today if you have the money. But if you're a long-term investor, medium-term fluctuations may seem painful at this juncture, but long-term markets have proven that persons who stay invested are rewarded for that. Having said all of that, though, could be harder to sleep at night if you purchase your portfolio here and in the space of 2 weeks, you see a retrenching in the portfolio. So what we do with our clients in markets like these is we use an averaging strategy where we will take a portion of the assets and invest it today. And then we have an agreed period, whether that's 30 days or 60 days, where we would have another tranche of assets on the sideline. If we got a significant dip, we use that as a buying opportunity to buy assets on sale. If not, we go ahead at the end of that period and put that tranche of assets to work. And then we have another tranche. And so we can divide it into 3 or 4, depending on the size of the portfolio that we're working with. And that way we provide some comfort to the investor. They're not missing out if the markets continue to rise. And if it takes a dip, they have new powder to put to work, as they say.
Thank you. So how would you be positioning investable assets?
That's a question that is determined by a evaluation of the individual who is coming to create the portfolio with us. Okay. What we do is we have a measuring tool and an interview process where we determine how much money the client is committing to the market, what their time horizon will be, what is their risk tolerance, what is their appetite for risk, and also their expected returns. And we take all of these things and put them into our tool and come up with what a appropriate asset allocation is for that investor. How much money should be invested into the stock market? How much should be invested into fixed income? And then in the stock market, how much should go to the US equity markets? How much should go to international equities? And if the investor is a Bahamian resident, we also take into factor what the investor is holding in the Bahamas or will continue to hold in the Bahamas in terms of investable assets, be that Bahamas government bonds, the registered stock, or investments in the local equity markets, or even real assets like income producing property. And we use all of that to design a portfolio that complements what the investor is holding currently.
Okay, thank you, Deno. So the interest rates, everybody's always concerned about the interest rates, but do you see it increasing anytime soon?
The interest rates have been trending up just gradually in the international space. And as the US decreases its bond buying, you're going to start to see people expecting a greater return in order to put money into fixed income assets. I don't see it going back to the levels that we were used to in the past. And so the traditional interest-only investor is going to have to look for alternatives to generate income from their portfolios. And there are strategies that we can look at to work with investors to help them to get better returns on their portfolios. Here in the Bahamas, it may be a different scenario. We're seeing that banks have lots of excess cash. We're seeing the government talk about reducing its expenditure, and so or its expenses, and so we may see bank interest rates continue to remain low at this period of time, and the government may consider, who knows, even looking at lower domestic borrowing rates going forward. But that remains to be seen.
Okay. So what are the best and the worst investments to use as a hedge against inflation?
Years ago, people would tell you that gold is the best hedge against inflation, but in this current environment, gold has not been providing the lift that investors are looking for. Maybe it's the cumbersomeness of holding gold. Maybe it's the fact that it doesn't pay out any interest and you have to pay for storage. And the fact that it's harder to put into use if you want to use it. But what we're saying is that fixed income assets are not a good hedge against inflation. Equities tend to be a much better hedge because companies have the ability to pass on increased pricing to consumers, and that increased profitability can be reflected in the stock price.
Okay, I have another question for you. Question says, I would like to know what industries should be looked at if diversifying business, especially in light of the pandemic.
What industries should be looked at? And that's a tricky question. I'm not sure whether a person is thinking about starting a company or diversifying an existing company, or whether they're working with an investable portfolio and considering which industries to focus on in that space. I am more qualified to speak about an invested portfolio of securities.
Okay.
And in that space, then what you do is you would want to look at industries that you expect to outperform as we normalize the economy, as more people are vaccinated and people start to move about more. So you may see more leisure type activities tend to perform. You'll see people going out and spending more money and spending money to be able to enjoy a lifestyle. So maybe things like companies like a Home Depot may be something that might start to see some lift in their stock prices. You may see airlines and cruise ships start to perform, because some people may believe that with the requirements to get on a cruise ship now, it might be there may be more, the percentage of vaccinated persons on a cruise ship may be a higher concentration than in their hometown where they're coming from. So they may feel safer on a cruise ship. I don't know, but what we do is we look at things like this, look at financials. As interest rates increase, banks tend to make more. And so those may be some of the type of things to look at. But we don't just pick 2 or 3 industries. We build a diversified portfolio across many industries, many sectors, and we may overweight or underweight the contribution to the sector depending on where we see potential for outperformance. All right.
Yeah. So I like that you've mentioned COVID, because we don't have a clue when COVID will be over. And I saw in your chart that you mentioned the countries that are like more vaccinated than others. I mean, in Jamaica, we said that we also have a set of anti-vaxxers. And so I'm asking you, like, what's the impact where COVID is concerned on asset prices?
It has been it has been varied in things where people can self-isolate, work from home. Those prices have skyrocketed. We've seen things like home prices go through the roof. The raw materials that go into home prices, I don't know in Jamaica, but in the US, in the Bahamas, we saw the price of a sheet of plywood going from maybe around $28, $30, $35 in the early part of 2021, going all the way up to above $80 in the last few weeks, in probably a month ago. So if you're in the middle of a construction project, trying to build a house, your now cost to complete that has gone up considerably, and that has funneled through into other raw materials. We've seen food prices go up, and we've seen shortages due to supply chain disruptions as areas get large COVID infections and plants have to shut down and supplies are not readily available. There's a pent-up demand, and that has caused some price inflation as well.
Well, Deno, I don't see any more questions at this time. I want to say thank you so very much. This economic overview was very, very insightful. Put things into perspective. Some things we already knew because we're living it every day. As we continue, we have about, I think, over 100 customers online. So I know they'll be reaching out to their premium relationship officer and possibly reaching out directly to you as well. So I want to thank everyone who's here with us online. Know that we're always here to advise you and to guide you in the right direction and to ensure that you're just very comfortable with the decisions you have to make, especially in these very unprecedented, uncertain times. Thank you so much for joining us. Please stay safe and contact us at any time. Have a wonderful evening, everyone. Bye.
Thank you very much, everyone. Bye-bye.